Hello, everybody, and welcome to UFile's podcast, Your Taxes Your Way. My name is Ida Celli, and I'm here with my colleague, Gerry Villaradas. Hi, Gerry. How are you?
How's it going, Ida? How's everything?
Good, you?
Pretty good, pretty good. I mean, we're still cooped up. It's after tax season. We're still cooped up in the pandemic, but it looks like there's light at the end of the tunnel. And I think today we're going to talk about a topic that's a little bit related to that, right? It's a little bit. It's unfortunately not necessarily a happy topic, but it's a little bit related to that. And
Yep.
So what are we going to talk about today? What's going to be the topic?
The topics today are are there tax efficient ways to raise cash in these trying times? However, I have a feeling these 5 points you will you will go over is not only for these trying times. They're good at all times, right?
Yeah, and that's precisely why you might be wondering, well, wait a minute, it's not tax season. Why are you guys doing a podcast here? I mean, it's not tax season right now. So why is it? It's because, the topic that we're talking about today is not related to tax season. It's basically, how can I raise cash in a tax efficient way? If I'm desperate right now, and this pandemic unfortunately has really, it's not just a health pandemic, it's also an economic pandemic as well, right? I mean, a lot of stores have shut down, a lot of people are still not working. So how can I raise cash but not run afoul of taxes, right? How could I do it in a tax efficient way? So that's what we're going to look at in this topic.
And the first point will be pulling money out of your TFSA.
Yeah, and that's the simplest one, right? I mean, that's the most common one, and that's the purpose of the TFSA. Okay, that's why it's called a tax-free savings account, right? Is that any investment you put in your TFSA is tax-free when you withdraw it. Okay, that's the whole point of it, and that's why it was designed originally when it first came about. So, regardless of what type of investment you have in there, whether it's just a bank account, whether it is whether it's locked-in funds, whether it's bonds, whether it's stocks that you have in there, well, once you sell those investments or liquidate those investments and pull the cash out of the account, well, that cash is tax-free. Nowhere to declare it on the tax return. It is completely tax-free. Okay, you can pocket it and do what you want with that money, and that's why it's the simplest way of raising cash, and it's of course one of the most tax-efficient way of doing it, because you literally pay zero tax when you're pulling out that money.
And how does it affect your limit?
So it does affect your limit. It affects in the sense that the good news about TFSA is whatever amount you pull out, okay, that amount gets added back to your limit in the following year. Now, I stress here that it's the following year that your limit gets affected, right? Because for those of you who are already at the limit this year and you decide to pull cash out, well, make sure not to put cash back in until next year, okay? Because your limit only comes back as of the following year, not in the current year. Okay, so if you were to do that, you were at the limit, you pulled out, and then you put back in, now you have over contributed on your TFSA, and you will be slapped with a penalty, which is usually 1% per month for the excess amount that you put in to your TFSA. Okay, so the key here is that to wait till next year if you're at the limit, but if you've got a large limit, if you haven't used up your maximum limit of TFSA, then you're fine. I mean, then you don't have an issue at that point. But if you're right at that limit, wait till next year to put the money back. But the good news is you gain back that room. So whatever you pulled out, you're able to put it back in the following year. You gain the room back.
So it's a win-win situation in this case.
Absolutely. And that's why it's the first one on our list, right? That it's the simplest,
correct,
the most tax efficient, and you get a bonus of getting your room back. That's why it's number one.
Okay, our second point is selling personal use assets.
Yes. So now we're, what's the old expression? You're selling everything that's not bolted down, right? So at that point, unfortunately, it is what it is, right? You might be at that situation where you need that cash. So at that point, what we mean by personal use items or personal use assets, what we mean is these are, assets that you use every day. So for example, it could be your television, it could be your smartphone, it could be furniture, it could be your car. Okay, so if you sell those assets to raise cash, well, it is likely you won't have any tax consequences when you sell it. You'll be able to pocket that cash tax-free. And that's for a specific reason. It's because these assets have usually lost value once you've used them. Okay, so these are personal use assets. So a car is very likely to have lost value from the time you purchased it, from the time you're going to sell it later on, because it's a used item. Your furniture will certainly have lost value. Your smartphones would have lost value. Your television would have lost value as well. So because you're selling these assets at a loss, well, whatever cash you raise from selling them will not trigger any tax consequence because you've sold them at a loss. Now, if you just so happen to sell them at a profit for whatever reason, then yes, that profit unfortunately would be taxable. Okay, you would have, and we're going to talk about selling assets at a profit later on. For the assets that I just mentioned as examples right now, it is highly unlikely that you will make a profit selling these assets. Okay, so because of that, you will be at a loss, and whatever cash you raise from there is completely tax-free. Now, there is a catch though. Now, like I mentioned, you are selling these assets at a loss. Okay, it's very likely you're selling them at a loss. Unfortunately, that loss is not tax deductible. Unfortunately, because to the government, they consider it as a depreciable asset, so it is a personal loss to you. Okay, so unfortunately, you cannot trigger a capital loss by selling those personal use assets.
All right. What about selling shares from non-registered accounts?
So that's probably from all the things that we're going to talk about today, that's probably the least efficient way, the least tax efficient way of raising cash. But it's still tax efficient to a certain degree. Okay. Now, what we mean by non-registered accounts, we mean you don't have these shares in an RSP or what we mentioned before, a TFSA. So with a TFSA, like I mentioned before, you could sell these shares in your TFSA, pull out the money, and it is completely tax-free. So you pay nothing on the gain and you pay nothing when you withdraw. Okay. That's the beauty of the tax-free savings account. But if you have shares in a non-registered account, meaning it's just a run-of-the-mill brokerage account, okay, that you have not registered under an RSP or any other, or TFSA or any other tax sheltered vehicle, then what happens is any profits you make will be taxable. Okay. However, the key here is that only half of those profits will be taxable on your tax return. Okay, let's take an example. I've got shares in a company I bought at $3,000. So I'm desperate right now. I need the cash. The stock has gone up nicely, and I sell them for $5,000 in the stock market. Okay, so I've got a $2,000 profit. Out of that $2,000, I pocket 50% of that cash. So $1,000 of that profit is tax-free to me. So I'm able to pocket that $1,000 and not pay any income tax on that $1,000. On the second portion, on the other half, this is the other half that will become taxable income on my tax return. So out of the $2,000 profit, I will declare $1,000 as additional income on my tax return. So it's still pretty tax efficient compared to other means of raising cash. For example, if you start a side gig, or for example, if you find another job, that income will be taxed basically at the same typical rates. Meanwhile, a capital gain, I'm only being taxed on half of the gains that I made. So it is quite a bit tax efficient, but obviously not as tax efficient as the other ones that we mentioned before.
It's better than nothing. That's what I keep saying.
Yeah.
Okay, the next one is a big one. Selling your personal home.
Yeah, and now we're really reached to the point of desperation, right? If you're at the point now where you need to sell your home to raise cash, we're really at the last resort, right? In this case, and it's all, and while the other means of raising cash is a lot quicker, although quite frankly, right now with the way the housing market is, how hot it is right now all over Canada, I mean, it's not unheard of to have people selling their homes within the day that they list them and for more money than what they listed it. That's how the market has gone right now. But it still takes time. By the time legal paperwork gets through, it still takes time before you get your cash. But selling your personal home, believe it or not, is actually one of the most tax efficient ways of raising cash. Okay. And the reason for that is that as long as you designate your home as your principal residence on your tax return, your gain on the sale of your personal home is tax exempt. It's tax free. So you pocket the entire profit. You pocket all the cash tax free, okay, when you sell your home. Now, it's not automatic. Okay, you do have to designate your property as what the government calls a principal residence for all the years that you lived in it, in order to trigger that 100% exemption of your taxable gain. okay, of the gain, excuse me,
Mhm.
of the gain. So you do this through a specific form, which is the T2091 that you have to submit with your tax return. Okay, so you have to produce that form and designate your home as your principal residence for all the years that you lived in it. The moment you've done that with your tax return, now your gain on your home is completely tax free. Okay, you get to pocket all the entire gain.
Okay, that's good to know. The next one is applicable for mostly students, I guess.
Yeah.
It's applying for scholarships.
Yes, and that's least understood, I would say, and that's the most
Mm-hmm.
unknown way of getting tax efficient cash. Is that if you're a student, okay, and of course, which student is not looking to raise cash somehow, right? I mean, let's not kid ourselves.
Obviously.
It's costly to go to university, So one tax efficient way for those students to get money and to get it essentially tax free is through scholarship income. I can use myself as an example. I've gotten my master's of taxation, and when I was writing my thesis to complete my master's of taxation, I decided to work for the university. I decided to do my thesis by doing some work for the university. The university reimbursed me and paid me for my services through a scholarship. Now you might say to yourself, well, why not do it through employment income? I worked in essence for the university. Why not do it through employment income? It's because the scholarship is actually more tax efficient. If you are a full-time student in the prior year, this year, and the following year, so meaning if we're talking about 2020 tax year, meaning 2021, 2020, or 2019, if you were a full-time student in any one of those years, okay, it doesn't have to be all three, just any one of them, your scholarship income is completely tax exempt. Okay, on
Oh,
your tax return, completely tax exempt. You don't even declare it on your tax return. That's how exempt it is. So it doesn't even reduce other benefits that you might be entitled to, like the GST credit. It won't even reduce that because it's not even taxable income on your return. Okay, so that you can't get more tax efficient than that. You can't it can't, it's nowhere near comparable to employment income. If I were to, for example, get paid as an employee by the school, well then I would have to declare that income as taxable income, and I get very few tax breaks on my employment income. I will get very few. But scholarship is completely tax exempt as long as I was a full-time student in one of those 3 years that I mentioned before. Okay, so prior year, current year, or the following year. As long as I'm a full-time student in any one of those years, completely tax exempt. I pocket the cash directly. What more can you ask for? I mean, you can't
exactly.
get any better than that. So for those who are listening to us right now or watching us on YouTube, I strongly urge you, check with your universities. There are plenty of scholarships that are offered, whether it is to do work for the university or the department that you're in, or whether for the diploma that you're going for, you might meet certain criteria to get a scholarship in this case, and you get tax-free cash. Go for it. Go check it out.
Wow, that's a lot of good tips. Now, this sort of concludes our 5 points. Any words of wisdom you want to give our listeners?
So the only thing I'm going to add is essentially everything that we just mentioned right now is found on our blog. Okay, so you go to ufile.ca and you go to the tab tips, and it's a tips tab, I believe, on the top there. Just simply go there. So tips and tools, excuse me. So tips and tools, and then you're going to find an option called the UFile blog. Okay, so when you go there, what we just mentioned, all the content of this podcast, what we mentioned right now, is in the blog, and you have links directly to sources on government website that will explain to you all these concepts. So we didn't just write about this article. We write a lot of articles throughout the tax season, a lot of interesting tax topics that can help you save money. Okay, so don't hesitate to go ahead and go and consult our UFile blog, which is found again on the ufile.ca website. Go to the tips and tools tab, and then hover your mouse and go to the UFile blog.
Excellent. So I guess this concludes our blog for our podcast for today, and I believe it's the last one of the tax season, unless you have another topic you'd like to discuss.
Yeah, well, I mean, you know what? Let's leave it up to people who are watching us or listening to us, or whether you're listening to us through a podcast, whether SoundCloud or Apple Music or Google Podcast, whichever one, or Stitcher. There's comments there. Don't hesitate. Just write a comment if you would like for us to talk about a specific topic in our podcast. For those of you who are watching through YouTube, there's comments right there. Go ahead and write a comment. Tell us, hey, I would love for you guys to discuss this topic, and we'll check it out, and we'll we'll see if we can create a podcast for you to discuss that particular topic. So don't hesitate to give us feedback.
Excellent. Well, thank you very much, Gerry. This was a very interesting tax season. So thanks a lot to everybody who's listening to us, and have a great summer.
All right. Take care, everybody.
Thank you.